everyone, and welcome to the subservicing scene. Today, we're going to be focusing on lender-placed insurance. I'm Mignon Davis, and I'm joined by Jen Hughes. Together, we run subservicing oversight here at Richie May. All right, let's dig in. We're going to start with the basics. What exactly is lender-placed insurance? Well, it's also known as force-placed insurance, and it's an insurance policy that a lender purchases on behalf of the customer if the customer's own insurance policy lapses for some reason or is deemed insufficient. So essentially, if the homeowner or the customer fails to maintain adequate insurance coverage, the lender steps in to protect their interest in the property and they purchase this policy. It's typically a very, very basic policy that really just protects the lender and does not really provide a lot of protection for the customer for losses of personal property inside the home.
Now let's discuss the specific CFPB requirements regarding lender-placed insurance. The CFPB has established a series of regulations to ensure transparency and fairness in lender-placed insurance practices. These requirements include notifying the customer before purchasing lender-placed insurance, clearly explaining the cost, and providing an opportunity for the customer to obtain their own coverage before the lender purchases the policy.
So let's elaborate a little bit on the notification requirements. The CFPB requires that lenders must send at least 2 notices to the customer before purchasing that lender's placed insurance policy. Now, the first notice should be sent at least 45 days before the lender places the insurance, informing the customer that their current policy has either expired or it's insufficient. And then the second notice must be sent no later than 15 days before the insurance is placed. Again, reminding the customer that their insurance has either expired or is insufficient, and that it reminds the customer of the impeding action if they do not provide proof of adequate insurance. So you're really giving the borrower 2 opportunities to provide that proof of coverage to the lender before they force place that policy.
The CFPB requires the customers must be given a reasonable period to secure their own insurance before the lender places the policy. This period is typically the time between the first and the second notice, allowing customers to present proof of adequate insurance.
All right, so now let's talk about cancellation. What do servicers do if the borrower or the customer provides that proof of coverage after they've already now placed this lender's insurance policy? What happens then?
Servicers must cancel the lender-placed policy and refund any money to the customer within 15 days.
Okay, so the regulations are designed to protect customers from unexpected costs and ensure that they have ample time and opportunity to maintain control over their insurance decisions. So by requiring clear communication and adequate time frames, the CFPB's goal is to prevent lenders from imposing costly policies without the customer's knowledge or consent.
Lenders need to navigate complex administrative processes to ensure compliance with CFPB regulations. This includes accurate record keeping, timely notifications, and managing customer responses. Additionally, lenders may also face logistical challenges in coordinating with insurance providers and ensuring the lender-placed policy meets regulatory standards. Many of our servicing clients utilize vendors to monitor and track insurance coverage on their portfolios. These vendors can also handle sending out the required notices for the servicer.
Yes, it's very, very handy and nice to have a vendor handling this process for you. Many of the servicing clients that we have use a vendor, and there's a lot of really good vendors out there who can do this for you. All right, thank you for your time today. We hope you found that this information was beneficial to you. And if you have any questions or would like to discuss how Richie May can help you, please contact us. And next time, we'll dive into another one of our subservicing hot topics. Stay tuned for that, and we'll see you next time.